This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Dave Rapach. Dave is a professor of economics at St. Louis University. Guess what? We're not talking economics today. Dave happens to be a professor who has put some academic chops behind trend following. So he's got down and got dirty, so to speak, and did a little digging, done some research, and he's put together the findings. Well, let me give you the short answer. The short answer, trend following works. But our conversation is the long answer. I hope you enjoy. Listen, let's jump right in because you might be the first. There's a handful of folks in your world, and this I would call primarily the academic world, that have dug in and done their homework and come to the conclusion that trend following works. There's very few of you that have actually taken the effort and, from an intellectual curiosity standpoint, gone in and figured it out and examined stuff like my books and said, is this guy Covel accurate or is he not accurate? And obviously, we're looking much beyond my books, but just the basic idea that trend following works. And this goes against so many of those professors, your peers and people that you've learned from over the years and decades, doesn't it?
I would certainly, on an important level, it does. At the same time, I was surprised as I looked in more depth at the literature. And again, it was just part of my sort of normal day-to-day research that I do in financial economics, publish or perish. I mean, I very much enjoy the challenges and excitement of cutting-edge research in doing the publish or perish rat race, so to speak. It can be very frustrating, but it's fascinating to me. But as I dug in more deeply, I was surprised to find that there were more people than you would perhaps think that were examining this, clearly in a minority. And clearly it was risky to pursue this and to try to publish in this area because at many journals, it would be very difficult to receive a fair hearing. Nevertheless, there was some openness, and I was particularly surprised to find some research that went against the conventional view that there's just nothing here.
Let me ask you this: how does it manifest itself when you're saying, okay, you're looking to publish maybe some work, and I'm just generalizing with this statement here, essentially trend following, and you're looking to publish? Some places are very accepting to the idea of new information and new ways to look at the world, but some are not. And so the ones that are not, how do they actually give you the big no? Is it just we want nothing to do with you? Do they tell you why? Do they argue with you? What do they do?
I mean, it obviously depends on the particular outlet, the particular, say, scholarly journal. It depends on the editor in charge of the journal, the associate editor that's handling your paper, the referees who analyze your paper. I think in general, it's just a number of, many academics haven't looked at this in detail, and I'm sympathetic to this view. There's this fundamental, no pun intended, suspicion of something like trend following. And they're familiar with just kind of the prevailing view. And so you tend to have quite a high bar. And people are going to be very concerned that you're just engaged in some sort of data mining. So I think in many situations, it's just perhaps on a positive note, to receive a serious hearing, you have to put together a very strong empirical case, right? You can't just go in there and say, the bar is going to be raised higher than it typically is, I think, in many cases.
I guess what's interesting to me is you're being very pragmatic just as you open this discussion. and you're talking about, empiricism and data and being objective. And then the people that run these journals sound like a bunch of, astrology, tea reading, people that, and I'm generalizing too, but that there's these walls drawn up to where they, to just say, oh, it's data mining, but to not even dig in. Now, it for some of them that are not digging in, I want to get more at what you think some of the reasons might be. Is a lot of this reputational in the sense that if you spend, this is what I've always theorized, if you spend decades establishing a certain view in finance or trading, and somebody comes along, another peer, another academic, or even some real world evidence, you don't necessarily want to adopt that because, doesn't it make you just less important, frankly?
No, that's a good point. And clearly there is the sociology of, the academic publishing sphere. And it plays a very important role without a doubt. And you can imagine, yes, just from a very basic psychological perspective, yes, if I've made a reputation putting forth a certain type of model, that can have strong explanatory power in many settings, right? If there's something that seems to cut against it in an important way, yeah, I'm going to be quite hesitant and perhaps dismissive. At the same time, there are perhaps what works somewhat in the favor and maybe can explain some of the recent studies that have reinvigorated academic interest in trend following is innovative and surprising findings are also valued. And so, but again, the bar is going to be raised very high. But if you can put together a strong case, that can catch people's attention. And I will say there were frankly some very, to my mind, quite courageous folks in the area of behavioral finance, and maybe that were willing to look at trend following for a long time. It was difficult to receive, again, a fair hearing, but these people they thought there was something there. They continued to pursue these research agendas, and they were able to make impact the profession. And also, there were editors at key points that were quite open-minded. From what I understand, Fisher Black is a very well-known.
You're so politically correct, Dave. You're so nice to everybody. Come on, why don't you tell me what you really think about some of these, mystics at the top of the ivory tower that don't want to change their mind because, frankly, they've got massive tenure and all that. Let me shift gears on you. I don't want to put you in a box. Okay, so listen. Let's go back a step or two. Let's talk about academic research in the 60s and 70s that looked at some of the trend following. And why don't you talk about what you found where some of the academic research back then was showing that the trend idea was uninformative. I'm going right back to the research and what they were showing in the 60s and 70s.
Right. So now keep in mind the context, right? So this is in the 1960s, especially at the University of Chicago, researchers began to compile these massive databases, right, with observations on especially a very large number of individual stock prices. So they come up with this wealth of data. Now we have the advent of modern computing power at that time, not the PC, right, but mainframes and what have you. And so there was this chance to just analyze this data in excruciating detail, perhaps. So what, in general, the research is somewhat mixed, but there were some very influential studies that essentially argued, look at changes in stock prices, i.e. stock returns. They're essentially unpredictable, right? The so-called random walk hypothesis, right? Just the day-to-day or month-to-month changes, you can't explain them in any systematic way. And any appearance of systematic trends, if you like, it's just, we'd expect these types of occurrences even under pure chance, no systematic patterns in these stock prices. So that was the prevailing view, right? And I think you may be familiar with Burton Malkiel's classic, A Random Walk Down Wall Street.
Why don't you define it's an entire book, obviously, but why don't you define just in a kind of a quick few paragraphs or sentences what his premise was?
So, in Malkiel's, I think the book was first published in the early 70s, and he's and gosh, what's the latest edition is, I don't know, probably something like the 10th or so. Don't hold me to that. But he basically championed the random walk theory, saying that there aren't these types of patterns in the data. And he even basically says fundamental analysis is of limited value, that the market is just...
You can't beat the index.
Yes, that's essentially. It's very efficient in that it's essentially a fool's errand, right? To try to beat the market on a consistent basis. You're best to just hold the market and minimize transactions costs in this way. And it's very influential. And again, it's a polemic. It's clearly a polemic, but it's a classic without a doubt. And Burton Malkiel has actually done some first-rate academic research, so we should give him credit for that. But at the same time, I mean, again, I think it does caricature it seems to me, especially in retrospect, for example, trend following. I mean, something cutting against that is, despite this spate of early academic research that said basically there's nothing there once we take a long, hard look at the data, is right. It's kind of interesting that trend following has been around for so long. I mean, if really it contained no useful information, you would think people who had a lot of money at stake, right, investors and managers, now maybe they're just using it for marketing purposes, but there's more than that at work if people are using it, right, for a long period of time. And when I read some of the Market Wizards interviews, I was surprised at how prevalently it was used by many of Schwager's so-called wizards. So that sort of cut against it. I said, well, maybe there's something there.
Yeah, I spent an afternoon down at Dunn Capital's offices last week. And
okay.
What's really interesting is there you see the track record that Bill and his team have put together since 1974. In price-driven, trend-following strategies, they make no bones about it. That's what they do. And now somebody could quickly come back and say, hey, Michael Covel, you've cherry-picked the one guy that's been around forever. And I don't think that's fair, because you can find plenty of other trend-following traders, same time periods, lengthy track records, et cetera, which kind of gives you some confidence, and enough confidence to say, hey, why has the academic community not looked at these particular people? On the flip side, I look at the greatest champion of value investing, and there's really only one fantastic Warren Buffett. And so if you were really to kind of, and this is a very cursory kind of analysis here, but if you wanted to yell survivorship bias, it seems like that the guy in Omaha, you would scream at it more than the trend following space. But it's the trend following space where they always just come back at me and say, well, Michael Covel, you have picked the lucky few winners that just happen to be the monkeys banging on the piano, and they cranked out Mozart. But no one says this about Buffett ever. It's very interesting how it unfolds.
No, I agree. In general, these types of concern, they do hold across the board, right? I mean, we have to be worried about survivorship bias and just how you analyze the data mining. Just this holds in general, and so we need to be very sensitive to this. I think what is actually quite surprising to me is the more recent studies that have a very high bar, and that have to, in the context of, I'll call it, rigorous academic research, they have to address all these issues. So the fact that there have been important papers published recently showing the efficacy of trend following is actually, to my mind, very powerful evidence, right? Because you have, number one, again, I think it's safe to say a suspicion, right? A somewhat, people are going to be very hesitant, editors, referees, to embrace what you're doing. They're going to need a great deal of convincing. And I mean, you have to play by the rules of rigorous academic research. Now, I don't want to overstate that, right? We don't have some, magic formula for uncovering capital T truth, but nevertheless, you have to do a lot of work, and you're constantly, that's the advantage of the peer review process. It's fraught with problems, but at the same time, people are saying, what about this? What about that? And you have to deal with these issues, especially the more substantive issues. And so in the end, in many cases, the research is quite rigorous, is very rigorous. And indeed, that's what stands out in my mind, is that these studies done in this framework have actually, they stood the test, right? They went through the refining fire, if you will.
Dave, here, get an example. Let's talk about the work. William Fong, David Shea, I believe I spoke to both of the guys over the years. Their work is, I think their paper, and there's multiple ones, but I think they really started to get the ball rolling even more, where they were the real kind of out of the gate to get this rolling. Or
I actually might go back. I might go back to a particular paper, and now this is interesting, right? This is published in the Journal of Finance, which is a premier journal. Again, I was quite amazed to learn about it when I started looking at trend following. I just wasn't familiar with this paper through many years of my research, but I wasn't focused on trend following, of course, at that time. So this paper by Brock, Lakonishok, and LeBaron was published in 1992 in the Journal of Finance, and they basically looked at the Dow and just constructed some very simple moving average, used some very simple moving average rules and breakout rules, and constructed signals, just buy and sell signals, and said, okay, suppose you just bought the Dow when you had a buy signal and sold when you had a sell signal. So a very simple rule, right? You're not diversifying in any way, but and they found that, wow, this portfolio performs quite well according to to the measures that we use in academic research, and leading models of stock price behavior that wouldn't make allowance, right? That don't leave any room for trend following, can't explain the behavior. Can explain our results, suggesting that, wow, there's something here. And I think that was actually a very important paper. Now, again, a host of issues were raised by it, but the fact that it was in Journal of Finance, this, I think, reintroduced technical analysis and trend following to the academic literature.
1992, right? 1992?
This is 92.
Okay.
Right. And there were some follow-up papers examining data mining, but it's actually a very nice paper. And again, I was very surprised to read it. It was quite influential in its own ways. But then, of course, you rightly point out Fung and Shea. In particular, they have a paper in 2001 where they, for the jargon, right? Is jargon alert. They construct these things called look-back straddles to essentially get a general measure of trend following behavior. To get some sort of portfolio that can track what's happening for trend followers in the managed future space. And they show that it has some very interesting properties, right? Now, again, this is how you would look at it as an academic, right? What does modern finance theory say? Modern finance theory tells us that, you earn a higher average return, right? You earn an average return above just the risk-free treasury bill rate, right, or return, by taking on risk, by taking on, more specifically, systematic risk. That's the only way, right? And in that sense, there's no free lunch. You want a higher return than a risk-free T-bill? Take on risk, okay? Now, of course, take on systematic risk. Now the question is, well, how do you measure systematic risk? Well, there's judgment there. There's no perfect way to do it, but we have ways that we've come to think as being, reasonably informative in academic research. Fung and Shea find that their trend following portfolio, I'll call it that as for shorthand, isn't strongly correlated. It's very weakly correlated with these risk factors. And yet you earn a relatively, nice positive return on average with these portfolios. So that's actually very difficult to explain, right, in the context of modern finance theory. You're basically getting a reasonably healthy return, but it's not because you're exposed to these important risk factors that exist. Furthermore, these portfolios, their trend following portfolios, do especially well in extreme markets, including extreme bearish markets, right? And from the standpoint, again, of modern finance theory, that's a conundrum. We would think that, right, you're especially concerned about having, holding an asset that in bad times does poorly, right? In bad times, if I have to accept, if my standard of living is already falling and I'm holding an asset that does poor at that time, that's going to lower my standard of living even more, right? I'm going to have to cut my consumption even more. And in that state of the world, that's when it's going to be most painful, right? What would I like? I'd like something that, when the world is coming apart, I have something that performs well, that restores my standard of living, and that's very valuable to me, right? And that's why we, for example, buy insurance even though it has a negative expected return. Right? What am I getting? I'm saying, well, I'm willing to accept a negative expected return because I buy this insurance because in a very bad situation, it's going to provide me with the resources. But trend following is giving you essentially a free lunch in this context, because in bad times it does well, but overall you earn a positive expected return. You don't have to pay for the insurance that you're getting. And that's actually very important. Again, this resonates with academics, and I think just with practitioners and everyday, and everyday people.
Can I put you on the spot?
Certainly.
So it's the nice setup, huh? Well, they just gave a Nobel Prize to a guy named Fama in Chicago, and he's got a comment out there where he's talked about market timing with moving averages, and he's called it an ancient tale with no empirical support. And so, I'm not asking you to take a spear or a nunchuck against the most recent Nobel Prize winner in economics, but what's going on there that he's so closed off to this? Is it what I was talking about at the beginning of our conversation, or is there a legitimate difference of opinion that he sees in the data than what you see in the data?
Okay, so it's very difficult to say. I mean, I can only speculate. Again, I think it's very important in these areas, and I'm trying to be, fair and open-minded, and not, although it may sound politically correct, but
I'll take the politically incorrect side. That's okay.
Okay. But no, actually, there's actually a particular point I want to make that I think goes to exactly what you're saying. So, first, Fama should clearly be given credit. I mean, his emphasis on empirical research and his openness to even, for example, his seminal research with Ken French saying, well, the so-called capital asset pricing model isn't an adequate way of measuring risk. His openness to empirical data, helping to develop the important data sets that we have that we use extensively in financial economics at the University of Chicago. He's to be given all the credit in the world for this. I think that's largely why he received the Nobel. It's kind of interesting. So another paper that when we went back and forth with a few emails that I think is very important is this very recent paper published in the Journal of Financial Economics that in 2012 by Moskowitz. I'm not sure how you pronounce the next person's name. OOI, is it Oy and Peterson? These are some very prominent researchers. Moskowitz, indeed, is a colleague of Fama's at the University of Chicago. And they have a paper called Time Series Momentum, and basically they construct using, I think, they have 58 equity, currency, bond, and commodity futures, and they construct essentially a systematic trend following portfolio, right? So they allocate across all 58 of these assets. They size their positions according to volatility. So, and they use a very simple buy and sell signal. So a very, very simple, they just literally look at what is the asset done over the last 12 months? If it's positive return, buy signal, negative return, sell signal. They construct this portfolio and they analyze it in detail and find that it does quite well. Again, not correlated strongly with the usual systematic risk factors. That is, it generates very sizable, I think much of your audience will know this jargon, right? It generates sizable alpha, indeed very sizable alpha, and it does very well in poor states of the world. And they say this is very difficult to explain using modern finance theory, how we usually think about risk. You have to delve into behavioral concerns or behavioral explanations or related explanations. But if you look at typically in an academic paper, right, there'll be something like a footnote at the bottom of the first page, and it will thank people who read the paper. And Fama is among the people that they acknowledge, that they thank for reading and providing comments on the paper. So
do you think some of it is that maybe, and I'm speculating here, that Fama is not as stridently against maybe what we're talking about, the very specific reactive trend following, and that maybe he is railing against some of the glossy stuff you see in the papers or guys on CNBC that, are trying to say they can predict a line swiggle or this or that.
Yeah, right. I mean, obviously we just don't know, right?
But he does come out and say moving averages, is an ancient tale of no empirical support. And moving average is a very specific phrase, and he's saying there's no empirical support to that. So
in this context, I mean, again, we don't know, and maybe let me say, people read my papers. I get feedback from my colleagues. That's a crucial part of putting together a paper. And I can have a person read my paper and say, I disagree with your findings, and here's why. And I thank the person for their comments, even if she or he still disagrees with me, right? And I try to address any valid concerns that they raise. And so we just don't know. But it is. I just found it very interesting that Fama read the paper and provided comments, and as did many other colleagues. I mean, again, this is to get a paper into the Journal of Financial Economics. Yeah, I mean, you need to present it to many colleagues. Typically, present it at leading conferences and get substantial feedback. But we don't know. Sometimes in the sort of the day-to-day, what shall we call it? Enterprise or even grind of academic research, right? You're forced, right? I mean, to look at the data and analyze it and work with with others and interact with others who are rigorously looking at the data. And, there's not much scope for these very colorful statements, right? This hyperbole. I mean, there's some of that, but, in another setting, if you're asked, maybe in a podcast interview, say, and the interviewer is trying to get you to say something provocative. Of course
I'm not trying to do that.
You're not trying to do that at all. No, I'm not. You're not trying to do that at all. I'm just saying.
Of course, I'm trying to do that. I love to do that. Why not?
I know, no, but I agree. I mean, sometimes you just need to
no, seriously. Let me take a step back. So I still, I enjoy talking with someone like yourself like this because look, I don't come. I did my requisite undergrad. I did the MBA program. And I was bored in school because I intuitively knew that a lot of these things that I was being handed, and a lot of it wasn't finance and trading, it just didn't have something behind it. So when I got out of school was when I first started investigating and finding out about trend following. And for me to walk into the disclosure documents of professional trend following traders and to look at this performance data, and then to look at all of their, I literally have every published word by every trend following trader, literally going back in the printed word going back, whatever format. And so to take all of their words, and they uniquely, I found as traders would often tell you exactly what they're doing. Not only would they tell you exactly what they're doing, then they had all this performance data to show you what they were doing. And then they would generally tell you what their rules were, and they would tell you what markets they're trading. And I looked at this whole avalanche of stuff that was coming across my plate. And they're literally, when I started doing this process in the mid-1990s, there was just nothing. There was nothing out there. And it just struck me. It was like, what is going on? To use the word academic, I thought to myself, I'm Mike Covel. I'm in a garage, okay, with no, quote, academic chops. And I'm digging through this stuff and I'm thinking to myself, but where are all the guys and gals and universities that have all the tenure? And I'm not trying to say, hey, I'm all that. I'm just pointing out, where was it people asleep at the wheel? Like, what was going on? Like, was there no curiosity in the university? How did this whole entire universe just get missed? I still don't get that.
And that's a deep issue, of course. And I mean, I think there are a lot of things going on here, right? First of all, again, you raise a host of issues. Let me just say first that, again, people were doing research in this area, right? So there's the paper in 92 that we talked about, right, by Brock et al., which I think was very influential, a very nice paper. But you're
okay, but we're talking about one paper.
No, they're actually more. I mean, we could put together a fairly lengthy list. I'll grant you this, though. But
you established. Hold on. You established at the beginning of our conversation it's a minority. So we know
absolutely,
it's okay.
I was about to say, as a percentage of papers published in finance, especially in the top journals,
infinitesimal.
Very small. Absolutely.
Okay.
Very small. But there were people who were looking at it, similarly to you. Now, again, it gets very complicated. I mean, I have great admiration for the underdog, if you will, in the sense that you kind of struck out on your own and said, I'm going to try this. I mean, I love that. That's a great story, right? I love academic. I suspect I have a genetic mutation or something of the sort that just, the enterprise of the research, even the publish and perish with all its frustrations, you get plenty of rejections, of course, in this game. But, I think I love the theories that are developed in science, testing it and doing this on a full-time daily basis. I mean, I think it's a great privilege, and I very much enjoy it. So I think you can come at things from very different perspectives. And so, whether it be as an academic researcher, I just sort of stumbled onto trend following as part of my research into financial economics and working with some co-authors.
You didn't have, I mean, look, a lot of people think today, they think, oh, Mike Covel has a trend following axe to grind. I likewise stumbled into it. I was completely fascinated. I didn't set out on this plan. And so likewise, why don't you explain that? You didn't wake up one day and be like, oh, I'm a trend following homer. No, you stumbled into this as well. You had no clue, right?
I mean, what happened is
you had a clue, but you didn't have a clue about trend following. You stumbled into it.
I started off primarily. I spent most of my as an academic researcher for a good part of my career, I focused on macroeconomics. Just in the context of my research in financial economics, especially, I focused more and more on forecasting and trying to understand, time variations in stock returns, where there are certain situations where you'd have a higher than usual return, others than a lower, other periods perhaps relating to business cycles or general economic conditions, right? Where you'd have a lower than average or higher than average return. What's going on? How can we explain these theoretically? How reliable is the empirical evidence? And just in the context of this, some of my co-authors had looked at trend following and technical analysis and found some favorable results. And as I looked into it more closely, I was like, wow, I was surprised again because of the conventional view in much of academe. I was surprised to find. So in that sense, I mean, I was quite surprised to find that it performed well. Again, and I'm very aware of the issues of data mining and what have you. But even after in my recent research, I've tried to explicitly control for data mining. You can't do that perfectly, of course, but the results stood up to those types of tests. And so, in that sense, similarly to you, right? I just stumbled into it. I mean, I wasn't saying, "Oh, I want to be this proponent," right? Again, I try to have an open mind about those. Again, we all have our preconceptions, right? Our biases, but in general, you try to push against those. And I just want to do interesting academic research. And at the end of the day, understand, try to uncover truths about how the world works. Now, it's very difficult in finance, right? Because in general, and you stress this from what and I hear this in some of in your interviews with traders, most of the movements in stock prices and asset returns more generally, of course, just unpredictable, right? Due to the arrival of news, right? But the point is, there are these components, these to my mind, systematic, predictable components. They're still relatively small and they're difficult to uncover, but I think they exist to a significant extent. And they're very worthwhile of academic study, and I think they can be used, potentially to improve portfolio performance.
Yeah, Dave, let me give you an example of where I was digging in the early to mid 90s. I was reading everything I could on Buffett. And I remember I was reading Martin Zweig's work, which was slightly technical, but and I was digging through Seth Klarman's Margin of Safety. And I was just laughing to myself that I just had a ton of books shipped from the West Coast to the East Coast, right? And so I knew one of the books in there, and I forgot to tell my assistant this. I knew one of the books was Seth Klarman's Margin of Safety. Well, the interesting thing is when I bought this book back in the early to mid 1990s, it was a $25 book, whatever. I don't know if you're aware of what's happened, but he only allowed one print run of like 5,000 books, apparently. right? So today, if you go on Amazon, Margin of Safety is like $3,000. So I was kind of chuckling to myself as I'm taking all these books out of boxes, and I'm like, well, there is the path that I thought I was going down, and I'm actually getting rewarded for not going the Margin of Safety route. And here's my $3,000 bonus. Thank you, Seth.
Yeah. But that's what I actually find it. In so many ways, in life, right? You have a certain view, and there's some evidence for it. But then you look more closely. You experience various things in your life again, and this is in many contexts, and you change your mind. We want to be able to do that. That doesn't mean anything goes, right? I'm always going to just. By my nature, I'm gonna be skeptical of certain things, and I want to see evidence. It needs to make theoretical sense to me, but then I also need empirical support. But be it in general, if you're thinking about how the world works in terms of the physical sciences, if you're thinking about sociological factors, politics, the economy, theology. This is how I think about all these things. And it's very right. It's great when you're able to go in different directions, to be surprised by how the world may work. And, I always retain an open mind that, maybe as I further look at the evidence, more evidence will accumulate over time, but maybe trend following doesn't work. You have to be open to that. Yeah. But at the same time, when you have substantial evidence that there's something there, it's fascinating to learn that just from a purely an intellectual standpoint.
There are some basic, if you think about it, we can kind of wrap up on this, but if you think about the foundation of ultimately, and this becomes speculation to some degree, but I don't know what else we have, but why does trend following work? And I think ultimately it comes down to some of the work in the behavioral finance and Kahneman and our other man up there at Princeton, whose name is Schiller, who just won the Nobel. So,
absolutely.
So these guys have laid out, really it's what's the condition of the human being and how do human beings react and work within money and uncertainty and happiness and choices and this and that. And so with biases built in every which way but loose. And so ultimately the question, will trend following work? Well, will value investing work? But ultimately these questions have to come down to, for me, what does the individual believe about human nature? And what does the evidence show about human nature? And I think the evidence shows that guys like Kahneman and Schiller they've got it going in the right direction, and Gerd, who I had on my podcast, and Dan Ariely, these guys have got it figured out what's going on in the human mind. And if anything, all their work says is that human beings are inherently uncertain. And if uncertainty is the norm and the state of the day, then boy, it sure seems like trend following is going to continue to have some efficacy going forward in the future.
Along that line, if I could be so brash as to point to just two recent studies that I've done, one about to be published and the other one that we're working on, getting ready to send it off to a journal. And so we look at, in the first paper, and I think it goes to precisely your point. So in the first paper, we focus more on trying to forecast or predict the market. Now, again, we realize there's going to be a small component here, but there's a very sizable academic literature that examines this issue. Can you look at, say, valuation ratios, interest rates or interest rate spreads, and does that provide an economically and statistically significant signal of, say, next month's S&P 500 return. Again, there's evidence that this is the case. The predictable component is small, right? There's still a lot of noise, right? And so we said, well, suppose we tried to incorporate information from technical indicators. How do these technical indicators stack up to these macroeconomic variables that have been examined extensively in the literature? And we found that the technical indicators perform as well or perhaps better than the leading macroeconomic suspects. And we were quite surprised by this. What we found, moreover, is that both the macroeconomic variables and especially the technical indicators were useful / informative in certain states of the world, namely during difficult economic times, for example, recessions. Right? So essentially, you have a situation where in quote unquote normal times, just in general, the returns are difficult to predict. And you essentially have something like, the random walk. But during certain states of the world, again, especially difficult conditions, recessions, trend following based indicators provide an informative, a useful, valuable signal. And I think that goes to what I think in these states of the world, right, that's where I think we tend to be risk averse, right? And I think uncertainty increases. So initially, when things start to deteriorate and you get these, if you will, bad shocks that accumulate and push the economy down into a recession, right? Early on, people become very uncertain. Stock prices fall, but people, they're unwilling to realize some loss, say, wow, things are getting expected future dividends, cash flows, earnings are down, I should sell. They're hesitant to do that. So you have this trend that emerges, right? But due to a number of psychological biases that are, that Kahneman, Tversky, and others, Schiller talk about in detail, information is not readily incorporated in the stock prices, and so these trends emerge, right? So early on, there's underreaction to what's happening in the economy. After a while, though, people begin to eventually see the writing on the wall, right, and say, oh my gosh, times are really bad. Dividends are going to be down. People in general become very risk averse in stressed situations when the economy's falling into a recession. And then people say, oh no, we need to sell. Well, then you can get herd behavior in the other direction, right? And so the trend continues in a downward direction. And so you end up with this protracted trend that these trend following signals are able to exploit. So I think as long as I don't know if this is an optimistic or pessimistic note, as long as we have recessions, trend following will probably work.
Well, I think it goes deeper than that. As long as we have human beings, we're going to have recessions. So,
the psychological factors, the foibles, if you will, that are highlighted in behavioral finance, I think they're exacerbated right there during stress conditions. And so in that sense, they manifest themselves in more profound ways. And I think we see this in general, right? I mean,
well, they can be exacerbated also in bubble situations. You could argue right now that equities are in a bubble, so they're exacerbated in that direction too. It's both ways, greed and fear, right?
I agree completely. So more extreme circumstances. And we see this in the data, right? The trend following, again, the data, the academic research, I should say, tend to do better in extreme up and down markets, and bubbles emerging and then bursting are leading examples of such extreme situations. I think, and I think you can appreciate this, right? I mean, the drawback to perhaps, right? I mean, from the standpoint of even marketing, if you will, is because systematic trend following portfolios, they're not highly correlated with the market, right? From the standpoint of modern finance theory, that's a good thing, if I can put it that way, because it generates alpha. But the drawback is if the market is doing particularly well, right, and you're performance isn't correlated with the market, you're going to be earning your normal expected return, but the market could be earning well above that for a particular period, right? Now, what's going to happen?
Your time horizon definitely can't be 1 or 2 years for any investing strategy.
Right, but just in general, even if I hold this portfolio over, decades, right? There are going to be extended periods potentially, right? Where again, I earn 5%, but the point is, I can earn 5%, 6%, say, in almost any state of the world, and that's what's valuable, right? Because inevitably, especially we're risk averse. What really concerns me is when the market tanks, right? But I can still generate 5% when everything else, right, is generating significant negative returns. That's very valuable. But the point is, right, people will always be able to come to you and say, oh, well, look at this period here where you underperformed the market benchmark by, whatever, 200-300 basis points. So in that sense, I've also done some recent research showing that we looked at like a portfolio of hedge funds in the managed future category, and we looked at a large number of categories, and we found that again these managed futures funds do very well. We came up with a way of demarcating good and bad times using different criteria, and we showed that these managed futures funds do very well in bad times, and they provide valuable hedges against bad times. And that's sort of what hedge funds are supposed to do, right? That's why we call them hedge funds, presumably. And again, this makes them quite valuable. And if you include a managed futures hedge fund as part of if you compare the performance, say, of a mundane 60-40 stock bond, right, just buy and hold portfolio, to a portfolio that goes, say, 40-30 into stocks, bonds, and a managed future hedge fund. The managed future hedge fund does much better, again, especially in bad states of the world. So it has very valuable hedging properties. And again, from the standpoint of both modern finance theory and just investor performance, this is quite valuable. I think that's why you see many institutional investors utilize the managed futures.
Dave, we're going to have to circle back and have another podcast here this year. We've outlined, look, you and I could talk for hours on this. But where can people go to find out specifically more information on you online? Where should they go?
Okay. They can go to my website, or they can email me. So my website is, let me make sure I get this exactly correct. Bear with me here. So my URL is cites.slu.edu/RAPACHDE. So it's sites.slu.edu/RapachDE. My email, and I check my email all the time. That's by far the easiest way to reach me, is rapachde@slu.edu, rapachde@slu.edu. SLU is St. Louis University. And I don't know if it matters. I have my LinkedIn address is just Rapach David, RAPACHDAVID.
We're going to have like a marketing class for the professors so they can kind of more easily get their information out of the public, instead of giving people the alphabet with like 16 million dots, I'm going to have a class for all the professors that I like across the country. Okay, guys, this is marketing 101. Let's get it right now.
Yeah, I agree.
Sorry, I had to take that hit.
No, that's fine.
They can find you. They'll find you.
I've had some payoff of trend following since. It's helped me. First of all, just intellectually, I've enjoyed the just examining it and the surprising findings, given the conventional view, and also, I've been able to get some nice publications out of it, which in the publish and perish game is. I only meant marketing in the sense that having to write down your website address was enough to cause me to have a quick aneurysm this morning. Yeah, but we want to get more. We want to get more papers out there, and absolutely,
you'll make them think.
Hey. Yeah, and there are more people out there than you would think. I mean, again, some of my colleagues, a number of my colleagues have looked at this.
If you could send me a list of more than 25 academics, let's start the debate about how many of them are out there.
Actually, that's an interesting project. Let's do that. That actually is interesting. So,
Dave, listen, you run. We'll talk again this year. And hey, thanks for taking your time today.
Yeah, and safe travels, and back to Asia.
Thanks, man. Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.